Fast Track Friday. For some reason, the recording didn't record, so I'm going to go ahead and give you a recap of what we went over. If you have any questions or any kind of details or needed about what I'm saying, please feel free to reach out. So I'm going to go and press play on the presentation and get going. Last week, we talked about leveraging bridge loans to close more business, and this applies to both listing agents and buyer's agents. And it could be a variety of different situations that your clients may be in. But remember, the most important thing is that you're a problem solver. You are giving your clients solutions to problems, even though they may not want to take your solution to consider it. You're at least there giving them a solution so that there's not somebody else talking in their ear and giving them those solutions. So a bridge loan, what exactly is it? It's just a short-term loan. It's not a long-term loan. Typically, it's 12 months or less. Some lenders have it 6 months or less. It's done on the current existing home. Typically, it's a primary residence, and they're looking to buy another one. Lots of times, they're moving out of state. Sometimes they may be moving within the same city, going from a smaller residence to a larger one, a residence in one neighborhood to another neighborhood, or even downsizing. So there could be a lot of different reasons for it. It bridges the gap between buying one house and selling the other one. And what it helps is for the seller to make a non-contingent offer. Most clients that I've encountered do require getting rid of one payment to qualify for another one. And in certain areas, I know Southern California, a lot of sellers don't want to accept an offer contingent upon the sale of another property because that's kind of tying their house up. It creates kind of a domino effect. So they may want the departing residents to already be in contract, which in many cases can create a situation where your seller is pressured to lower their price or give concessions, or buyers may see that as, they've got, which they do in many ways, have the upper hand to negotiate more concessions, leaving your seller kind of out of pocket for more than they would normally be out of pocket for if they had the time to market it, if they weren't pressured, a variety of different reasons. So it is suited for people that want to move quickly. They've got a lot of equity, but they don't have a lot of cash on hand. And other people that just don't want to sell in a rush. So that's what a bridge loan is. There's a lot of different banks versions of bridge loans because a bridge loan is not a standard conventional conforming loan. It's not like an FHA or VA. It's a portfolio loan. Each bank that we have, and we have 13 different banks at C2 Financial that we currently work with that have a version of a bridge loan. Usually it could be an interest-only loan, or it could be fully amortized, 6 to 12 months. So we can tailor the strategy based off of what your particular client needs and wants. My favorite one is the one from Lensure. And one reason that I like it is because it does not require monthly payments on the loan on the departing residence. It's a 12-month loan. You can cash out up to 75% of the equity of the house that they're looking to sell. It's okay if it's listed. A lot of loans you can't list the property, or if you do a cash out refinance before you list the property, the lender will have what's called an EPO, early payoff penalty, if they sell that house within 6 months or pay the loan off. So the bridge loan is a perfect solution for your seller that needs money from their departing residence to purchase the other one and can't qualify with two payments, or they don't want the financial stress of having two payments. So they'll pull money from this one that they're leaving to put a down payment on the next property, and the bank lender wants to do both. So they'll do both loans together. Or there's another version they have that they could just pull money from here. If it's enough to pay cash for the next one, that's fine, perfect. They'll pay cash. I've got several clients that have reached out to me that are looking to downsize. They're relocating from states that have properties that have high value, like California or New York, and they're doing a bridge loan there, and then they're just going to buy their house in cash in the new state that they're looking to relocate to. So that is an option. Keep that in mind. The benefits of the boost loan, very, very simple. No monthly payments. You are accruing interest on that loan. It is not interest free. Keep that in mind, please. So, but there's no monthly payments being required. The interest is just building up, and then when they sell the property, they will go ahead and pay off that balance. There's no debt to income ratio issues. So many borrowers, as I mentioned, can't handle two payments, don't want to handle two payments, can't qualify with two mortgages. So this eliminates the problem. And non-contingent offers in some states, due to the market, due to the competition, you'll have a lot of sellers that are just not willing to consider an offer for your buyer, which may also be your seller, with a contingent transaction in the works. How to present to buyers and how to present to your sellers. So keep in mind, we're problem solvers, right? We're just giving them options. Hey, this lender told me you're a bridge loan. Let's have a conversation. Let's see if it's right for you. It may not be right for them that second, but after a while, that property's been on the market for a while, you may remind them, hey, do you want to take a look at that bridge loan again, just to kind of keep things moving? It avoids, the stress of being pressured to sell. It brings buyers peace of mind. If I can sell this, pull money from here and not worry about a payment, and let my house sit on the market the time it needs to be able to, have your real estate agent market it properly. um, you've They can take money out for moving costs. They can even take money out for renovations. This is one of the beautiful things that the representative from Lensure mentioned, is you don't have to take all the money and put it in the other house, and you don't have to take out the full 75% of equity. You just, it's paying off the existing mortgage, and your loan can go up to 75%. So they can pull some money from that. You get them out of the house. You come in there and let them maybe put a little bit of paint, fresh coat of paint on there, stage the house, make it look like a model home. Maybe they're wanting to do some renovations. Maybe the flooring needs to be changed. Maybe they really do want to do that kitchen remodel to get the most bang for their buck for the property, because in many markets we're seeing that properties that are not renovated are not selling as quickly and not getting the max offer that they could potentially get, because the house needs a lot of work. These loans, he told us on Friday that the rates are in the low nines, and it's about 2 to 2.5 points cost. So it's not, it's not free money. They are paying some points up front, and the rate is higher than they were to take a regular, cash out loan on a primary residence. But we've got to sell this to them in perspective. If How bad do they need to move? Can they move? Can they get the house they want? And let them kind of weigh their own options. If you vacate the property and you're able to stage it and use some of the money to spruce it up, can they get more money for the sale of the property and recoup these initial upfront costs? So that's food for thought. That's numbers you can crunch with them and discuss strategies with them. Okay. Getting that higher sales price, getting their offer accepted non-contingent, and not being in a bind. In many cases, I've seen sellers that are in a contingent situation that they're going to lose their dream home, and they're just pressured to, okay, let's chop the price. And they're cutting the price on the departing residents, making less money there when they could have just given it enough marketing time to be on the market, leave the home, stage it, and do what you need to do as a professional real estate agent to sell their property for the maximum sales price that the market can currently bear. And another thing that he mentioned is that we can collect rental income on the departing investment property. So if it's a property that can Airbnb itself and you've got it listed, I mean, you could potentially let them rent it out for a bit. So that's not a hard stop for them. Frequently asked questions. So when you do the bridge loan, how much can be kept versus how much is going to the remodel or down payment of the new home? They don't give you a limit. It's just you can borrow up to 75% of the current value of the house. You do have to pay off the existing mortgage. It's refinance. So they refinance that. If the home is free and clear, the borrower can use the proceeds as they wish. There is an option for them to pay cash for the other house if the other house is at a lower price point. The loan term is 12 months. So they have 12 months with no payments. Interest is accruing, though. Keep that in mind. And there are no monthly payments during that period. At the end of the 12 months, what happens if the house has not sold? That's a great question. So they don't want to foreclose on our clients. They'll do a refinance for us under a DSCR, debt service loan, which a DSCR loan is taking into consideration the rent that you can get for the property. And as long as it's offsetting the principal and interest, PITI payment, then the DSCR loan won't work. And there are versions where the payment can be slightly below the rent. And there are options that is called the note ratio, that just if the rent doesn't fall in line at all with the payment. But those are the things we can discuss. There's a lot of options. And these are just some examples that I use, kind of interesting, at a lower price point market. And the next one's going to be at a higher net worth. This is a property that he brought up. It's pretty close to the beach here. It could definitely be selling for more, and just not getting these price cuts. But the house does need some updating. Your seller could go ahead and spruce this property up a little bit before the sale, maybe attract some better offers. And higher net worth, you could see here, it's been, the market has been shifting in Florida, so that's part of it. But these higher net worth clients may just want to move on. They may be okay with just putting this particular house under a bridge loan and using those proceeds and buying the other one and not having the payment. So there's a lot of scenarios. The main thing is to give your clients options so that you're looking like the professional and the problem solver. And that's really what our clients are looking for, is a guidance. So that's all for my presentation. We did kind of go into some Q&A in the last presentation. I'm doing these every single Friday. I'm moving it back 1 hour so that a few agents can come in and listen in. I will be recording them. This last recording didn't work, but Sylvia Sanders with C2 Financial. Please connect with me if you have any questions. I'm here to help. I love being the problem solver. I've been in lending 20 years. I've been a loan officer 20 years, and I was a teacher for 10 years before. So I do have a passion for educating and helping agents reach their full potential. Let's not forget, we are dealing with probably the biggest financial decision that most of our clients will ever make. So the more you know, the more tools in your tool belt, the better you can serve them. And quite honestly, that just leads to more referrals because you become the expert. I look forward to seeing you this Friday, and please reach out with any questions. Thanks.